There is a simple, almost deceptive question that sits at the very heart of modern capitalism. It's a question that, when answered correctly, unlocks fortunes, builds empires, and defines legacies. When answered incorrectly, or worse, when it is never even asked, it becomes the silent architect of failure, the unseen force that hollows out great companies and evaporates wealth. That question is this: do you bet on the horse, or do you bet on the jockey? For nearly a century, the entire apparatus of high finance, of business schools, of investment analysis, has been built to answer the first half of that question. We have been taught to analyze the horse. We build intricate discounted cash flow models, we scrutinize balance sheets, we calculate price-to-earnings ratios, we debate gross margins, and we forecast market share. We measure the speed of the horse, the strength of its legs, the quality of its pedigree. We become experts in the quantitative, the measurable, the data-driven reality of the business itself. And yet, Warren Buffett, the man who has compounded capital more successfully than any human in history, has built his entire $900 billion empire, Berkshire Hathaway, on the bedrock of the second answer. He bets on the jockey. This isn't a small preference, it is the fundamental genetic code of his success. It is the core philosophy that explains why he bought a small Nebraska furniture store from a Russian immigrant who couldn't read English, why he invested billions into a bank on the brink of collapse during the greatest financial crisis of our time, and why he passed on the tech giants of the dot-com bubble while the rest of the world called him a dinosaur. Buffett understands a truth that is often too human, too messy for the spreadsheets and algorithms to capture. A great jockey on a mediocre horse has a chance to win the race. A terrible jockey on the best horse in the world is almost guaranteed to find a way to lose. A great leader can navigate a troubled industry, fix a broken business model, and inspire a team to achieve the impossible. A poor leader, a person of flawed character or clouded judgment, will take a fortress of a business with impenetrable moats and, through a series of seemingly small, foolish decisions, erode it to rubble. This is the antidote to the sterile, purely quantitative analysis that dominates so much of our thinking about business and investing. It's an acknowledgement that a company is not an inanimate machine of assets and liabilities. It is a living, breathing organism, and its character, its drive, and its destiny are inextricably linked to the character, drive, and destiny of the person at the helm. So today, we are going to deconstruct this principle. We are going to move beyond the simple platitude of betting on people and build a rigorous, actionable framework based on Buffett's decades of practice. We will explore the 5 pillars of this philosophy, the 5 non-negotiable elements he looks for in a leader, an entrepreneur, a partner, or a key employee. This is not just a lesson in investment analysis. This is a masterclass in talent acquisition, in choosing business partnerships, in leadership, and in the critical art of human due diligence. This is the final promise, that by the end of this journey, you will understand that the single most important decision for success, in business and in life, is learning how to bet on the right people. Our first pillar, the very foundation upon which all others are built, is the most crucial and the most unforgiving. It is the one quality that Buffett believes is not just important, but acts as a multiplier for all other virtues, or, in its absence, a catalyst for utter destruction. That quality is absolute, unwavering integrity. Buffett has a famous saying that encapsulates his entire human resources philosophy. He says, "We look for 3 things when we hire people. We look for intelligence, we look for energy, and we look for integrity. And if they don't have the last one, the first 2 will kill you." Think about that for a moment. An intelligent, energetic person without integrity is not merely ineffective, they are dangerous. They have the brains to figure out how to exploit the system and the energy to do it on a grand scale. They are the architects of the Enrons, the WorldComs, the Wells Fargos. They are the ticking time bombs on a corporate balance sheet. For Buffett, integrity is not a soft skill or a nice-to-have virtue. It is the ultimate risk management tool. To truly understand how deeply this principle is seared into Buffett's soul, we must travel back to the sweltering summer of 1991. The world of high finance was shaken to its core by a scandal emanating from one of its most powerful and aggressive firms, Salomon Brothers. Salomon was a titan of Wall Street, a bond-trading powerhouse where fortunes were made and lost in the blink of an eye. And Berkshire Hathaway was its largest shareholder, with a $700 million preferred stock investment. The scandal was a bombshell. A rogue trader at Salomon, Paul Moser, had been discovered submitting false bids in U.S. Treasury auctions, a flagrant violation of federal law designed to corner the market. But the true crisis wasn't just the illegal act of one trader. The crisis was the cover-up. The firm's top leadership, including its hard-charging, cigar-chomping CEO John Gutfreund, had known about the transgressions for months. They had been aware of the rot in their own house and had done nothing. They had failed the integrity test. The market reaction was swift and brutal. Salomon's clients, the largest financial institutions in the world, began to flee. The firm was hemorrhaging cash. It was on the verge of a liquidity crisis that could have led to a catastrophic bankruptcy, wiping out Buffett's entire investment and potentially triggering a systemic crisis in the financial markets. The U.S. Treasury Department, furious at the deception, banned Salomon from bidding in its auctions, a move that was effectively a death sentence for a bond trading firm. The company, and with it, Buffett's massive investment, was teetering on the abyss. In this moment of pure crisis, Buffett was forced to act. He flew to New York and, in a dramatic showdown, the board installed him as the interim CEO of Salomon Brothers. The folksy investor from Omaha was suddenly thrust into the center of the largest Wall Street scandal in a generation, tasked with saving a firm infected by a culture of arrogance and greed. His very first act as CEO was not to analyze the trading books or to cut costs. It was to address the shattered integrity of the firm. He gathered the thousands of terrified Salomon employees and delivered a message that would become legendary, a speech that perfectly articulates his entire philosophy. He told them, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." In that single sentence, he reset the entire value system of the company. He made it clear that financial capital was replaceable, but reputational capital was not. The firm's survival depended not on its trading acumen, but on regaining the trust of the market, the regulators, and the public. He then went before the United States Congress and delivered a mea culpa of stunning humility and frankness. He didn't deflect or make excuses. He took full responsibility. He told them, "I will not ask for a slap on the wrist. I will ask for a fair punishment." Salomon has been a house where the top officials have paid little attention to the rules of the road. He promised a clean house to cooperate fully and to install a culture of compliance and ethics. This raw display of integrity, of taking responsibility when the previous management had shirked it, was what saved the firm. The Treasury Department, convinced of Buffett's sincere commitment to reform, eventually softened its stance, allowing the firm to survive. Buffett had stared into the financial abyss, a crisis created not by a bad business model or a market downturn, but by a simple, catastrophic failure of integrity at the top. The experience burned a lesson into his mind. A business can survive a bad year, it can survive a bad product launch, it can even survive a recession. But no business can survive a terminal lack of integrity in its leadership. The psychological principle underpinning this terrifying story is a combination of two powerful concepts: the agency problem and the theory of the slippery slope. In finance and economics, the agency problem describes the inherent conflict of interest that arises when one person, the quote, agent, in this case, a CEO like John Gutfreund, is expected to act in the best interests of another, the principal, the shareholders like Warren Buffett. The agent has different motivations, a bigger bonus, more power, personal prestige that may not align with the principal's goal of maximizing long-term, sustainable shareholder value. Integrity is the only force that bridges this gap. A leader with integrity internalizes the principal's goals as their own. They act as a true steward of the capital entrusted to them. Without integrity, the agency problem becomes a breeding ground for self-serving decisions. A CEO might chase a risky, ego-driven acquisition to build a bigger empire, even if it dilutes existing shareholders. They might cut corners on safety or compliance to boost quarterly profits and their own bonus, creating massive long-term liabilities. The leaders at Solomon knew about the illegal bids, but reporting it would have created a short-term crisis, hurt their bonuses, and tarnished their reputations. So they chose the path of silence, a decision that served their own interests but nearly destroyed the company for the shareholders. They were intelligent, they were energetic, but their lack of integrity turned those qualities into weapons of mass destruction. This connects to the psychological theory of the slippery slope. Catastrophic ethical failures rarely begin with a massive premeditated crime. They begin with a small transgression, a tiny compromise. Perhaps it's a slightly embellished expense report, or looking the other way at a minor compliance breach. The brain, in a process known as ethical fading, normalizes the small sin. The next compromise becomes a little easier. The line between right and wrong begins to blur. The culture at Solomon was one where pushing the envelope was celebrated. Paul Moser likely started with small rule-bending that was ignored or even tacitly encouraged. This created a slippery slope where submitting blatantly illegal bids in a multi-billion-dollar government auction seemed like a justifiable, even logical next step. A leader with integrity acts as a brake on this process. They hold the line not just on the big issues, but on the small ones. They understand that a culture of integrity is built not in grand pronouncements, but in the 1,000 tiny decisions made every single day. By ignoring the initial signs of rot, Gutfreund allowed the slippery slope to become an avalanche. Buffett's entire due diligence process for people is designed to detect a person's susceptibility to this slide before he ever writes a check. So how do we translate this into a practical, applied mental model? How can you, in your own life, whether in hiring, investing, or choosing a business partner, systematically screen for integrity? The blueprint is the front page of the newspaper test, combined with a forensic approach to a person's history. It's a three-step process. Step 1 is to reject the tyranny of the formal interview and the curated reference list. Anyone can perform for an hour in a conference room. Anyone can provide you with a list of 3 people who will sing their praises. The real data is found in the shadows. You must conduct deep, off-list reference checks. Talk to people who worked for them, not just with them. Talk to former subordinates who have no reason to be anything but candid. Ask questions like, what was it like to work for this person during a crisis? Can you tell me about a time they had to deliver bad news? Did they ever ask you to do something that made you feel uncomfortable? The patterns that emerge from these conversations are far more revealing than any resume. Step 2 is to probe for ethical frameworks using hypotheticals. Don't ask, are you an ethical person? The answer will always be yes. Instead, present them with a difficult gray area dilemma relevant to your business. For example, imagine we are about to lose a major client. You discover a minor, temporary flaw in our competitor's product. If you highlight it, you will likely save the client, but it feels like a cheap shot and could damage our reputation for fair play. If you don't, we lose $1 million in revenue. There is no right or wrong answer, but walk me through how you would think about that decision. What you're listening for is not the answer itself, but the asterisk process. Do they immediately jump to a profit-maximizing conclusion? Or do they weigh the second and third order consequences? Do they talk about stakeholders, reputation, long-term trust, and the identity of the company? This single exercise reveals more about a person's character than a dozen standard interviews. Step 3 is the ultimate filter, the test Buffett himself espouses. Before making a final decision, ask yourself this simple question. Would I be comfortable with every single action this person takes, every decision they make, and every word they say, being reported in detail on the front page of our local newspaper, to be read by our customers, our employees, and our families. This is not a literal prediction, but a powerful mental model. It forces you to move beyond competence and charisma, and to consider the totality of a person's character under the harsh light of public scrutiny. If you feel even a flicker of hesitation in answering that question, if there is a small voice in your head that says, well, as long as nobody finds out, then you must walk away. That hesitation is your early warning system, detecting the potential for a catastrophic failure of integrity down the road. The antithesis to this rigorous approach is the path walked by the 99% of investors, executives, and entrepreneurs. It is the path of seduction by surfaces. Most people are disastrously bad at judging character because they overvalue the wrong signals. They are seduced by impressive credentials from elite universities, by a polished and charismatic presentation style, and by a track record of seemingly impressive short-term results. They hire and partner with the person who has the best resume, not the best character. This leads them directly into the trap of the charismatic sociopath, a common archetype in the business world. This is the individual who is brilliant, energetic, and utterly charming, but lacks a moral compass. They are masters of impression management, telling you exactly what you want to hear. They climb the corporate ladder with ruthless efficiency, leaving a trail of betrayed colleagues and broken promises in their wake, yet always managing to fail upwards because their superficial metrics of success are so compelling. The greatest example of this in corporate history is the story of Enron. Jeff Skilling and Andy Fastow were the architects of one of the largest corporate frauds in history. They were not unintelligent, they were brilliant. Skilling was a Harvard Business School graduate, a visionary who was hailed as a genius. Fastow was a financial wizard who created complex off-balance sheet vehicles that were, for a time, celebrated by Wall Street. They were also overflowing with energy, driving a hyper-competitive, aggressive culture known as rank and yank, where the bottom 10% of performers were fired each year. They had intelligence in spades. They had energy in abundance. What they lacked was a shred of integrity. They built a corporate empire that was, in reality, a house of cards, hiding billions in debt and faking profits. The investment community, the analysts, and the board of directors were all seduced by the surface story. They saw the rising stock price, they heard Skilling's charismatic vision of the future of energy trading, and they ignored the glaring red flags and the sheer impossibility of the numbers. They bet on jockeys who looked fantastic in the paddock, only to discover they were intentionally steering the horse off a cliff. The result was a $7 billion bankruptcy, the dissolution of Arthur Andersen, one of the world's largest accounting firms, and the loss of life savings for thousands of employees. It stands as the ultimate monument to Buffett's warning: intelligence and energy, without integrity, will not just fail you, they will kill you. The financial connection here is direct and brutal. In accounting, we are taught to think of assets as tangible things: cash, inventory, factories. But the most valuable asset a company has, and one that never appears on the balance sheet, is its reputation. A reputation for integrity is a powerful economic engine. It lowers your cost of capital because banks and bondholders trust you more, offering you better terms. It reduces regulatory risk because government agencies are less likely to subject you to punishing scrutiny. It acts as a magnet for A-level talent. The best people want to work for leaders and companies they admire, which lowers your costs for talent acquisition and reduces employee turnover. It builds deep, resilient customer loyalty, creating the brand equity that allows for premium pricing. All of these are tangible financial advantages. A single, catastrophic failure of integrity can incinerate this asset overnight. When the Salomon Brothers scandal broke, the firm's market capitalization plunged. When the Wells Fargo account fraud scandal was revealed, the bank paid billions in fines, and its stock languished for years, dramatically underperforming its peers. The financial cost of lost integrity is not theoretical. It can be measured in the billions of dollars of shareholder value that vanish into thin air. Investing in leaders with integrity is therefore not an act of moral idealism. It is the most pragmatic form of financial risk management there is. It is the first and most important pillar in building an enterprise that is not just profitable, but enduring. Having established integrity as the non-negotiable bedrock, we can now turn to the second pillar of Buffett's framework, a specific and potent form of intelligence. When Buffett speaks of intelligence, he is not referring to a high IQ, a degree from an Ivy League university, or the ability to solve complex mathematical equations. He is talking about a much rarer and more valuable quality, rational intelligence. This is the ability to think clearly, to make decisions based on evidence and logic rather than emotion and bias, and to have a deep, almost innate, understanding of the fundamental economics of a business. It's about seeing the world as it is, not as you wish it were. It's a temperament, a discipline of the mind that protects a leader from the most destructive forces in business: ego, greed, and fear. The living embodiment of this principle for Warren Buffett was a man named Tom Murphy, the former CEO of Capital Cities/ABC. Buffett has said on numerous occasions that Tom Murphy comes closer to being the ideal business manager than anyone he has ever met. Murphy was not a flashy media mogul in the mold of a Sumner Redstone or a Ted Turner. He was understated, humble, and relentlessly rational. Over a period of several decades, he and his partner, Dan Burke, took a tiny, failing television station in Albany, New York, and built it into a media empire that included the ABC television network, ESPN, and numerous newspapers and television stations. They did this not through grand, visionary pronouncements, but through a methodical, almost machine-like application of rational intelligence. Their story is a masterclass in this second pillar. The foundational anecdote that illustrates Murphy's genius is the 1985 acquisition of the ABC television network. At the time, Capital Cities was a successful but much smaller company. ABC was a lumbering giant, 3 times its size. On paper, it was a minnow swallowing a whale, a deal that screamed of hubris and excessive risk. The entire world of Wall Street was skeptical. But Murphy and Buffett, who helped finance the deal and joined the board, saw it with a cold, rational clarity that others lacked. They weren't buying the glamour of a television network or the allure of Hollywood. They were buying a collection of assets at a price they understood to be a bargain, and they had a clear, logical plan to unlock its value. Murphy's rational intelligence manifested in 2 key ways. First was his approach to capital allocation. He was pathologically allergic to what he called institutional stupidity. He would not overpay for an asset, no matter how prestigious or strategic it seemed. He and Burke analyzed the ABC acquisition with brutal objectivity, focusing on the cash flow the assets could generate, not on abstract synergies or glamorous projections. They knew that the owned and operated television stations in major markets like New York, Los Angeles, and Chicago were cash-generating machines, and the value of those stations alone nearly justified the entire purchase price. The network itself was almost a free option. While other media executives were caught in bidding wars for trophy assets, Murphy waited patiently for the right opportunity at the right price, acting with decisive force only when the numbers made undeniable sense. Second, and perhaps more importantly, was his rational approach to management. Murphy believed in extreme decentralization. His philosophy was simple: hire the best possible people, give them the resources they need, and get out of their way. The Capital Cities corporate headquarters was famously Spartan, with a tiny staff. They didn't believe in layers of bureaucracy or endless meetings. They believed that the people on the ground, running the local television station or newspaper, knew their markets best. This was a radically rational approach. It acknowledged the limits of a central authority's knowledge and trusted in the power of individual ownership and accountability. After acquiring the much larger ABC, with its bloated corporate culture, Murphy and Burke applied their rational system with surgical precision. They cut wasteful spending, eliminated redundant management layers, and empowered talented executives. They didn't do it with anger or malice. They did it as a simple, logical necessity to make the business as efficient and profitable as it could be. Tom Murphy's entire career was a testament to the power of a clear, unemotional, and logical mind. He demonstrated that in the long run, the quiet, disciplined application of rational intelligence will always outperform the loud, ego-driven decision-making that so often masquerades as visionary leadership. For Buffett, he was the perfect jockey. The underlying psychological principle that makes rational intelligence so rare and powerful is its ability to override our brain's most primitive and flawed wiring. Our minds are riddled with cognitive biases, mental shortcuts that helped our ancestors survive on the savannah but are disastrous in a modern business context. A rational leader is, in essence, someone who has trained themselves to recognize and counteract these biases. Two of the most pernicious are confirmation bias and the affect heuristic. Confirmation bias is the tendency to seek out, interpret, and remember information that confirms our pre-existing beliefs. If a CEO believes a certain acquisition is a brilliant idea, they will unconsciously favor data that supports that conclusion and dismiss data that contradicts it. They'll listen to the advisors who agree with them and label the dissenters as not being team players. This creates a dangerous feedback loop, an echo chamber where a bad idea can gain unstoppable momentum. The affect heuristic is even more subtle. It's the shortcut our brain takes when it makes a decision based on a quick, emotional gut feeling rather than a prolonged, analytical process. We think, I like this industry, or this founder seems like a winner, and that positive feeling colors our entire assessment, causing us to overlook obvious risks. Emotion literally hijacks the rational part of our brain, the prefrontal cortex. A leader who is excited about a new technology or enamored with the glamour of a certain industry is highly susceptible to this bias. They feel like the decision is right, so they stop looking for reasons why it might be wrong. A rational leader like Tom Murphy actively fights these tendencies. They have the intellectual humility to know they are fallible. They actively seek out disconfirming evidence. They listen more carefully to the person who disagrees with them. They build systems and processes that force logic and evidence to the forefront, pushing emotion and bias to the side. They trust the numbers, not their gut. This is an exhausting and unnatural way to think, which is why so few leaders are capable of doing it consistently. How can you cultivate this kind of rational intelligence in your own decision-making? The applied mental model is a powerful two-part framework. The inversion method, championed by Buffett's partner Charlie Munger, and the simple two-column ledger. It's a blueprint for stripping emotion out of any major decision. Step 1 is inversion. Instead of starting with the question, how can we make this project a success, you must invert it. Ask yourself, if we wanted this project to fail spectacularly, what are all the things we could do to guarantee that outcome? Make a list. We could overpay for the assets. We could hire the wrong team to run it. We could neglect our existing customers while we chase this new thing. We could run out of cash. We could misjudge the competition. This simple act of inversion forces your brain to see the problem from a completely different angle. It illuminates risks that were previously invisible because you were blinded by optimism and confirmation bias. Munger famously said, "All I want to know is where I'm going to die, so I'll never go there." This is the essence of inversion. Identify the paths to failure so you can systematically avoid them. Step 2 is the two-column ledger, a technique borrowed from Benjamin Franklin. Take a clean sheet of paper and draw a line down the middle. On the left side, list every reason for Knives making the decision. Be brutally honest and stick to objective facts and data, not feelings. It will increase our market share by an estimated 10%. It will generate an estimated $5 million in free cash flow within 3 years. On the right side, list every reason against the decision, using the risks you identified during your inversion exercise. It will require taking on $20 million in new debt. It distracts our best engineers from our core product. Our primary competitor has a 10-year head start. Then you must weigh them, not by counting the number of items in each column, but by assessing the magnitude and probability of each point. This simple, manual process forces a slow, deliberate, and logical analysis. It takes the jumbled, emotionally charged chaos of a big decision inside your head and organizes it into a clear, rational framework on paper. It is the antidote to the gut feel, affect heuristic style of decision-making. The antithesis of this rational approach is the all-too common archetype of the visionary CEO. This is the path of the 99%. Our culture lionizes the charismatic, bold, risk-taking leader who paints a grand vision of the future. Sometimes this works, but far more often, it is a recipe for catastrophic value destruction. The visionary CEO becomes a victim of their own press clippings. They fall in love with the sound of their own voice and the grand narrative they are spinning. They are prone to making huge bet-the-company acquisitions that are more about feeding their ego and making headlines than about creating per-share value for their owners. They get swept up in industry fads, pouring billions of dollars into the hot trend of the moment, be it the dot-com bubble, the metaverse, or the current AI gold rush, without a clear, rational path to profitability. The poster child for this kind of failure was the disastrous 2000 merger of AOL and Time Warner. At the time, Steve Case, the CEO of AOL, was hailed as a visionary, the king of the new internet economy. Gerald Levin, the CEO of Time Warner, was the head of an old media empire desperate to be seen as relevant and forward-thinking. Together, they concocted the largest merger in corporate history, a deal born of pure hubris and narrative fallacy. The vision was grand. The marriage of new media distribution with old media content. The reality was a catastrophic clash of cultures, a mountain of debt, and the complete evaporation of the synergistic fantasies that had justified the deal. They weren't guided by a rational analysis of cash flows and sustainable competitive advantages. They were guided by a story, a vision of the future that they had told themselves so many times they believed it had to be true. The result was the destruction of over $200 billion in shareholder value, one of the greatest financial disasters in history. It is the ultimate cautionary tale of what happens when a compelling vision is not tethered to the cold, hard ground of rational intelligence. The direct financial connection of this pillar is measured by one of the most important metrics in all of business: return on invested capital, or ROIC. A business is a machine for turning capital into more capital. ROIC measures how efficiently that machine is working. A truly rational leader understands that their primary job is to be a steward of capital. They will only deploy $1 of the company's money, whether on a new factory, a marketing campaign, or an acquisition, if they are highly confident that it will generate a return that is significantly greater than the company's cost of capital. A leader driven by ego or vision, on the other hand, will often deploy capital into projects with low or even negative returns, simply because they are glamorous, strategic, or new. Imagine two companies over a decade. Company A is run by a rational allocator like Tom Murphy. It's in a boring industry, but every year it generates a steady 15% return on its capital. It doesn't make splashy headlines, but it methodically reinvests its profits into projects that also earn 15%. Company B is run by a visionary CEO. It's in a hot, exciting industry. It makes bold acquisitions and is constantly in the news. But its projects are a mixed bag. Some do well, but many are expensive failures. Its average return on invested capital is only 5%. At the end of 10 years, the power of compounding will have turned Company A into a financial powerhouse, its stock price having multiplied many times over. Company B, despite all its sound and fury, will have created very little real value for its owners. Its stock will have stagnated or declined. Rational intelligence is not about being a genius. It's about having the discipline to avoid stupidity. And in the world of business, the consistent avoidance of stupidity, expressed through a high and sustained return on invested capital, is the surest path to extraordinary wealth. With the foundations of integrity and rational intelligence firmly in place, we arrive at the third pillar, the force that transforms good intentions and smart plans into tangible results. This is the pillar of energy. When Buffett talks about energy, he's not just talking about working long hours or having a caffeinated personality. He's describing a relentless, proactive, almost obsessive drive to push the business forward. It's a deep-seated impatience with the status quo and an insatiable desire to solve problems and seize opportunities. It is the engine of execution. An intelligent leader with integrity might have the perfect plan, but without the propulsive force of energy, that plan remains a blueprint on a shelf, collecting dust. The energetic leader is the one who grabs the tools and starts building. There is no better illustration of this principle in the entire Buffett saga than the story of Rose Blumkin, the founder of the Nebraska Furniture Mart. Her story is so legendary, so perfectly representative of raw entrepreneurial energy, that it sounds like a tall tale. But it is all true. Rose Blumkin, better known as Mrs. B, was a Russian Jewish immigrant who fled persecution and arrived in America in 1917. She couldn't speak a word of English, let alone read or write it. After settling in Omaha, Nebraska, she saved up $500, and in 1937, she started a small furniture business in the basement of her husband's pawn shop. This was the humble beginning of what would become the largest home furnishing store in North America. Mrs. B's business strategy was brutally simple and executed with ferocious energy. Sell cheap and tell the truth. She bought goods as cleverly as she could, took a razor-thin markup, and relied on massive volume. But it was her energy that was her true competitive advantage. She was a force of nature. She worked 7 days a week, from the moment the store opened to the moment it closed. She was the chief buyer, the head of sales, the floor manager, and the marketing department all rolled into one. She was famous for haggling with suppliers with a tenacity that bordered on terrifying. She would ride around the store on a motorized cart, even into her late 90s, barking orders, negotiating deals with customers, and ensuring every single aspect of the operation met her impossibly high standards. Her energy was infectious. The people who worked for her were not just employees, they were disciples of her relentless work ethic. In 1983, Warren Buffett, a longtime admirer of her business, decided he wanted to buy the Nebraska Furniture Mart. The negotiation was as unconventional as Mrs. B herself. Buffett went to see her and simply asked, "How much do you want for the business?" She scribbled a number on a piece of paper. Buffett looked at it and said, "Okay, I'll buy it." The deal was sealed with a simple handshake. There were no armies of lawyers, no teams of auditors conducting due diligence. Buffett famously said he would rather trust Mrs. B's word than the audited financials of any other company. He was not just buying a collection of buildings and inventory, he was buying into the culture of relentless energy that she had created. He was betting on the jockey. The story doesn't end there. After selling 90% of the business to Buffett, Mrs. B, then 89 years old, promised to stay on and work. And she did, with the same fire as always. A few years later, after a dispute with her grandsons who were then running the business, she quit in a huff at the age of 95. But did she retire? Of course not. She took her life savings and opened a brand new, massive furniture store right across the street, directly competing with the business she had just sold to Warren Buffett. Her new store, called Mrs. B's Clearance and Factory Outlet, was so successful that it started taking a significant chunk of business from the Nebraska Furniture Mart. Buffett was left with no choice. He had to go back to Mrs. B, now 97 years old, and acquire her second company. He had been out-hustled and out-energized by a woman who was nearly a century old. Rose Blumkin was the human embodiment of the multiplier effect of energy. Her intelligence was in her simple, powerful business model, her integrity was in her motto of telling the truth, but it was her inexhaustible nuclear-level energy that built an empire from a basement. The psychological principles that explain the power of such energy are the Pygmalion effect and the concept of an internal locus of control. The Pygmalion effect, also known as the Rosenthal effect, is a well-documented phenomenon where higher expectations placed upon people lead to an increase in their performance. A high-energy leader is a walking, talking Pygmalion effect. Their own drive, their own passion, their own high standards become the expectations for the entire organization. Their belief that problems can be solved and goals can be achieved becomes a self-fulfilling prophecy. This energy is contagious. It cascades down through the management layers and infects everyone from the executive suite to the loading dock. A team led by a high-energy individual will always outperform a team led by a passive, low-energy manager, even if both teams have identical resources and talent. The leader's energy sets the pace. Furthermore, these leaders possess a strong internal locus of control. This is a psychological term for the degree to which people believe they have control over the outcomes of events in their lives. A person with a strong internal locus of control believes that their own actions, hard work, and decisions are the primary drivers of their success or failure. They are the captains of their own ship. A person with an external locus of control, on the other hand, believes that their life is dictated by outside forces, luck, fate, the economy, unfair competition. Mrs. B never once blamed a recession or a competitor for a bad sales week. She saw every problem as something to be solved through her own effort. This psychological orientation makes a leader proactive, not reactive. They don't wait for things to happen. They make things happen. They see a challenge not as a roadblock, but as an obstacle to be overcome through the application of focused, relentless energy. So how do we translate this into a practical model for our own professional lives? The blueprint is the first 100 days action plan. This is a framework for channeling raw energy into productive, focused action. Whether you're starting a new job, taking over a new team, or launching a new venture, it breaks the initial, critical period into 3 distinct phases. The first 30 days are for diagnosis. This is a period of intense, high energy, listening and learning. Your goal is to absorb as much information as possible. Talk to everyone, your employees, your customers, your suppliers, your harshest critics. Go to the front lines. Work a shift on the factory floor or in the call center. Your objective is not to make changes yet, but to identify the biggest levers for improvement, the key constraints, and the most promising opportunities. This phase requires immense energy to overcome the inertia of a new role and truly understand the landscape. The next 30 days are for prioritization. Now that you've diagnosed the situation, you must resist the temptation to try and fix everything at once. This is where most low-energy managers fail. They get overwhelmed and default to inaction. A high-energy leader uses this phase to focus their force. You must identify the top 3 to 5 initiatives that will have the most disproportionate impact on the business. These are the big rocks. What are the critical few actions that will build momentum and create visible, meaningful change? You must be ruthless in saying no to everything else. This act of prioritization is a key function of productive energy. It's about applying force where it matters most. The final 40 days are for execution. This is where your energy becomes visible to the entire organization. You launch your prioritized initiatives with a clear plan, clear metrics, and a public display of leadership. You secure early wins. These small victories are crucial. They build morale, create momentum, and demonstrate to everyone that a new, more energetic era has begun. The first 100 days plan is a structured way to convert the potential energy of a new start into the kinetic energy of tangible results. It prevents aimless activity and focuses your drive on what truly matters. The antithesis of the energetic leader is a tragically common figure in the corporate world, the bureaucratic manager. This is the path of the 99%. This individual is not a builder. They are a caretaker. Their primary goal is not to advance the business, but to preserve their own position and maintain the status quo. Their energy is directed not towards growth and innovation, but towards risk mitigation, process adherence, and internal politics. They are masters of presiding over a slow, graceful decline. The culture they create is one of complacency and entropy. It's a world of endless meetings where decisions are deferred. Reports are commissioned to study problems rather than solve them, and action is stifled by layers of approvals. The default answer to any new idea is no, or worse, let's form a committee to study it. This bureaucratic malaise was a key factor in the slow-motion collapse of retail giants like Sears. For decades, Sears was an unassailable fortress of American retail. But over time, its leadership became bureaucratic. They were caretakers of a legacy, not energetic builders of the future. They were slow to adapt to changing consumer tastes, slow to embrace e-commerce, and mired in a cost structure that made them uncompetitive. While energetic entrepreneurs like Sam Walton at Walmart and later Jeff Bezos at Amazon were relentlessly experimenting, driving costs down, and obsessing over the customer, the management at Sears was busy managing a complex, unwieldy bureaucracy. The energy had drained from the building. It became a place of process, not progress. The result was a decades-long slide into irrelevance and eventual bankruptcy. It serves as a stark reminder that no competitive advantage, no matter how dominant, can survive a sustained lack of energy in its leadership. The direct financial connection of this pillar is found on the top and bottom lines of the income statement: revenue growth and operating margin. A high-energy leader has a direct and quantifiable impact on both. Their drive and passion push the sales and marketing teams to find new customers and enter new markets, which manifests as higher year-over-year revenue growth. Their impatience with waste and inefficiency energizes the entire organization to find better, faster, and cheaper ways of doing things. This relentless focus on operational excellence expands the company's operating margin, the profit it makes on each dollar of sales. Think about it. A 1% improvement in the operating margin of a $10 billion company is an extra $100 million in profit. That's real, tangible value, created not by some clever financial engineering, but by the focused application of human energy. When Buffett saw Mrs. B, he didn't just see a charismatic old woman, he saw a human dynamo whose energy translated directly into the highest sales per square foot and the leanest operating costs in the entire industry. He was buying a torrent of free cash flow generated by an unstoppable force of will. Energy, in business, is not just a personality trait. It is a direct driver of financial performance. We have now established the three core personal qualities of the ideal jockey: the integrity to be a trustworthy steward, the rational intelligence to make sound decisions, and the energy to drive results. But there is a fourth pillar, a mindset that ties all of these together and aligns the leader's interests perfectly with those of the owner. This is the pillar of the owner's mindset. There is a vast and crucial difference between a manager who thinks like a hired hand and one who thinks like an owner of the business. The hired hand is a tenant, renting their position. The owner-manager is a steward, tending to a property they feel is their own. This distinction in mindset dictates how they handle every dollar, every opportunity, and every risk. It is the secret ingredient that ensures a leader will act in the long-term best interests of the company, even when no one is watching. The quintessential anecdote for this pillar is the story of Berkshire Hathaway's 1972 acquisition of See's Candies. This deal was a major turning point for Buffett and Munger. It was the first time they paid a premium price for a truly excellent business, shifting away from their earlier strategy of buying mediocre, cigar-butt companies at dirt-cheap prices. See's was a phenomenal business. It had a beloved brand, a loyal customer base, and incredible pricing power, the ability to raise prices each year without losing customers. But the true genius of the investment was not just in the business itself, but in the management that came with it, led by a man named Chuck Huggins. Chuck Huggins ran See's Candies for decades, both before and after the Berkshire acquisition. He did not own a significant portion of the company himself, but he managed it with the meticulous care and penny-pinching frugality of a founder who had built it from scratch with his own life savings. He was the embodiment of the owner's mindset. He was obsessed with maintaining the quality of the product, refusing to compromise on ingredients even when it would have been more profitable in the short term. He understood that the brand's reputation for quality was its most precious asset. He was also famously frugal with corporate expenses. There were no lavish headquarters, no unnecessary luxuries. Every dollar spent was weighed against its potential return. Crucially, Chuck Huggins understood the concept of capital allocation from an owner's perspective. See's Candies was a wonderful business, but it didn't require enormous amounts of capital to grow. It generated far more cash each year than it needed to maintain its operations and open a few new stores. A typical hired hand manager, an empire builder, would have been tempted to take that excess cash and reinvest it into wasteful ego-driven projects, perhaps a flashy new headquarters, or a risky international expansion, or an acquisition of a completely unrelated business. Chuck Huggins did the opposite. He recognized that the cash generated by See's could likely earn a higher return elsewhere. So every year, he dutifully sent the excess cash back to headquarters in Omaha, where Warren Buffett could then redeploy it into other, more promising investments. This was an act of profound intellectual honesty and discipline. Huggins didn't need Buffett to micromanage him or tell him what to do. His owner's mindset naturally led him to the exact right decision for the true owners of the business, the shareholders of Berkshire Hathaway. He treated Berkshire's capital as if it were his own sacred personal wealth. The underlying psychological principles that create this powerful mindset are the endowment effect and its close cousin, loss aversion. The endowment effect is a cognitive bias where people place a higher value on an object that they own than they would be willing to pay for the same object if they did not own it. Ownership creates a psychological bond. An owner-manager feels this endowment effect for the entire company. It's their business. This feeling is not just emotional. It has profound financial consequences. It triggers loss aversion, the principle that the pain of losing something is psychologically about twice as powerful as the pleasure of gaining the equivalent amount. For a manager with an owner's mindset, wasting $1 of company money feels like a personal loss. The pain is visceral. They will fight tooth and nail to avoid a $100,000 loss, while a hired hand might see it as a rounding error in a large budget. Buffett's genius is in finding leaders who are psychologically wired this way, even if they don't have significant equity ownership. He looks for people who have an innate sense of proprietorship, who feel the endowment effect and loss aversion for the business's capital as if it were their own. This creates a perfect alignment of incentives, far more powerful than any complex executive compensation plan. How can you adopt this owner's mindset in your own work or identify it in others? The applied mental model is the $1 rule for capital allocation. This is the single most important question a leader can ask. For every dollar of profit that we retain in this business, are we creating at least $1 of market value for our owners? This question should be the filter for every major decision. The blueprint for applying it is a 3-step process. Step 1 is to identify all of your options. At the end of the year, after you've paid all your expenses, you have a pile of cash, the company's profit. As a leader, you have 5 basic things you can do with that money. You can reinvest it back into the existing operations, buy new equipment, hire more salespeople. You can use it to make an acquisition. You can pay it out to your owners as a dividend. You can use it to buy back the company's own stock, or you can use it to pay down debt. Step 2 is to rigorously calculate the expected long-term return for each of those options. This requires intellectual honesty, not wishful thinking. What is the realistic after-tax return we can expect from that new factory over the next 10 years? What is the true synergistic value of that acquisition after all the costs and integration headaches? What is the return to shareholders from buying back our stock at its current price? Step 3 is the crucial filter. You must only deploy that dollar into options where the expected return is greater than what the owners could likely earn for themselves if you just gave them the money back. This forces an incredible discipline. It transforms the leader from a mere manager of operations into a true capital allocator, a steward whose primary job is to maximize the long-term per-share value of the enterprise. A leader who lives by this rule will never fall into the trap of growing the business for the sake of growth alone. The antithesis of the owner's mindset is the destructive path of the empire builder. This is the most common pathology of the hired hand CEO. The empire builder's primary motivation is not to increase per-share value, but to increase the size and prestige of the domain they rule. Their compensation is often tied to the size of the company's revenue, not its profitability. They are driven by ego and the desire to be on the cover of magazines. This leads them to pursue growth at any cost. They are serial acquirers, constantly buying other companies, often in unrelated fields, in a process Peter Lynch famously called diversification. These acquisitions are rarely about strategic fit or rational returns. They are about getting bigger. The empire builder loves to construct lavish, monumental corporate headquarters. They insist on having a fleet of private jets, and they approve bloated executive compensation packages for themselves and their cronies. They are spending house money, an abstract pool of corporate funds that they do not feel a personal connection to. Their focus is on the size and grandeur of their empire, not the wealth of the citizens, the shareholders, within it. The corporate landscape is littered with the wreckage of companies destroyed by empire builders, conglomerates that became so bloated, complex, and inefficient that they eventually collapsed under their own weight. The direct financial connection of the owner's mindset is clear and powerful. It maximizes the long-term growth of per-share book value and the generation of free cash flow. Free cash flow is the lifeblood of a business. It's the cash left over at the end of the year after all expenses and necessary capital expenditures have been paid. It's the money that can be used to create real value for shareholders. An owner-manager is obsessed with maximizing free cash flow because they see it as the fruit of their labor. The empire builder, in contrast, often torches free cash flow on wasteful projects and overpriced acquisitions. The ultimate report card for a CEO, in Buffett's view, is the long-term growth rate of the company's book value per share. This metric smooths out the volatile swings of the stock market and measures the real, intrinsic growth in the underlying value of the business. A leader with an owner's mindset, who treats every dollar of retained earnings as precious and reinvests it wisely, will naturally compound the company's book value at a high rate over time. This is the ultimate financial proof of their stewardship. When Buffett looks at a jockey, he isn't just looking at their resume. He's trying to determine if they are psychologically capable of being a disciplined, long-term compounder of his capital. This brings us to our fifth and final pillar, the one that acts as a governing mechanism for all the others. It is the quality that harnesses integrity, intelligence, energy, and an owner's mindset, and directs them toward their most productive end. This is the pillar of the circle of competence. The idea is simple, yet its practice requires a level of intellectual humility that is exceedingly rare among successful people. A great leader, a great jockey, must not only have a clear understanding of what they know, but they must have an equally clear and brutally honest understanding of what they don't know. They must have the discipline to operate exclusively within the boundaries of their own competence, resisting the siren song of opportunities that lie outside of it, no matter how tempting or popular they may be. A great jockey knows which races to enter, and more importantly, which races to avoid. The most dramatic and consequential example of this principle in action was Warren Buffett's own conduct during the dot-com bubble of the late 1990s. It was a period of mass hysteria. The stock market was roaring, driven by a new paradigm of internet and technology companies. Companies with no profits, no revenues, and sometimes no finished product were going public and achieving market capitalizations in the billions of dollars. It was a gold rush, and anyone who wasn't participating was branded a fool, a relic of a bygone era. And the most prominent of these so-called fools was Warren Buffett. While the world was clamoring for tech stocks, Buffett and Berkshire Hathaway were resolutely on the sidelines. They continued to invest in businesses they understood: insurance, consumer goods, banking. The pressure on Buffett was immense. Barron's, the influential financial weekly, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article mocked him for being out of touch and for missing the greatest bull market in history. Financial analysts and television pundits openly questioned whether the Oracle of Omaha had lost his magic touch. His own shareholders were growing restless, watching their Berkshire stock underperform the soaring NASDAQ index. Through it all, Buffett remained completely unfazed. His response was simple and consistent. He didn't invest in these companies because he didn't understand them. He couldn't confidently project their cash flows 10 or 20 years into the future. He didn't have a firm grasp of their long-term competitive advantages. Because they fell outside his circle of competence, he simply said no. He was willing to accept the temporary pain of looking foolish in order to avoid the permanent pain of a catastrophic capital loss. And then, in the spring of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal and protracted collapse, eventually losing nearly 80% of its value. Hundreds of dot-com companies went bankrupt, wiping out trillions of dollars of investor wealth. It was a financial bloodbath. And through it all, Berkshire Hathaway, with its portfolio of boring, understandable businesses, stood as a rock of stability. Buffett's discipline, his stubborn refusal to venture outside his circle of competence, had been vindicated in the most spectacular fashion imaginable. He had not just preserved his shareholders' capital, he had a mountain of cash ready to deploy into the wreckage at bargain prices. This episode was the ultimate testament to the power of intellectual humility. The best jockeys don't have to ride in every race. They just have to be smart enough to know which ones they have a high probability of winning. The psychological principle that makes the circle of competence so vital is the Dunning-Kruger effect. This is a cognitive bias in which people with low ability at a task overestimate their own ability. In short, they are too incompetent to recognize their own incompetence. The business world is filled with leaders suffering from the Dunning-Kruger effect. Success in one area, say building a great retail company, breeds overconfidence, leading a CEO to believe they are a genius in all areas. They then take the company's capital and make a disastrous foray into a field they know nothing about, like software development or movie production. The genius of a truly great leader, a great jockey, is that they have the self-awareness to counteract this bias. They have a healthy, paranoid fear of the unknown. Their confidence is high, but it is narrowly confined to the areas where they have deep, hard-won expertise. This intellectual humility is the ultimate defense against the ego-driven mistakes that destroy so much corporate value. How can you define and enforce your own circle of competence? The applied mental model is the three baskets framework for decision-making. It is a simple but powerful tool for personal and professional auditing. First, you draw 3 circles on a piece of paper. You label them in, out, and too hard. The in basket is your circle of competence. Here, you list the industries, business models, technologies, and types of problems that you understand deeply. This is not about what you've read about or what you find interesting. This is about the areas where you have genuine, demonstrable expertise. Your best and most confident decisions, your major investments of time and capital, should come almost exclusively from this basket. The out basket is for things you definitively do not understand and have no intention of trying to understand. For Buffett, this might be biotechnology or cutting-edge software. For you, it might be international shipping logistics or oil exploration. The discipline here is to be honest with yourself and to place things in this basket without shame. The world is too complex for anyone to be an expert in everything. Trying to be is a fool's errand. The out basket protects you from your own ignorance. The third basket, too hard, is the most important for maintaining discipline. This is the purgatory for tempting ideas. These are the opportunities that seem exciting and are often fashionable. Everyone is talking about them. Your friends are getting rich from them. But if you are brutally honest with yourself, you don't truly understand the long-term dynamics or competitive advantages. The temptation is to do a little bit of research and then convince yourself you understand it enough to move it into the N basket. This is how bubbles are born. The true discipline is to leave these ideas in the too hard basket indefinitely. It is the act of saying, maybe this is a great idea, but it is not for me. This framework forces you to honestly assess the boundaries of your own knowledge and gives you a system for resisting the powerful social pressure of FOMO, the fear of missing out. The antithesis of this disciplined approach is the all-too-common path of chasing trends and diversification. Most leaders and investors are driven by FOMO. They cannot bear to sit on the sidelines, while others seem to be making easy money. They see a competitor making a successful move into a new area, and their institutional imperative, the mindless imitation of one's peers, kicks in. They feel compelled to follow suit, regardless of whether they have any core competencies in that new area. This leads to the disastrous process of diversification. A successful, focused company decides to diversify, but instead of strengthening the business, the diversification weakens it. A classic example would be a highly profitable manufacturing company that sees the high valuations of software companies and decides to launch a software division. They have no experience in software development, no culture of innovation, and no understanding of the sales cycle. The venture becomes a black hole for capital, distracting management and draining resources from the core business that was once a jewel. They have strayed from their circle of competence, and they pay a heavy price. The path of the 99% is to believe that you must be everywhere. The path of the master is to understand that you must only be where you have an undeniable edge. The direct financial connection of this final pillar is to the concept of risk-adjusted returns and the margin of safety. Investing and business strategy in general is not just about maximizing returns. It is about maximizing returns relative to the risk taken. By operating exclusively within your circle of competence, you dramatically reduce the probability of a catastrophic, permanent loss of capital. Your deep understanding of the business, its customers, its cost structure, its competitive landscape, acts as the ultimate margin of safety, a concept pioneered by Buffett's mentor, Benjamin Graham. A margin of safety is a buffer against error, bad luck, or the vicissitudes of the economic cycle. For Graham, it was often found by buying a stock for significantly less than its tangible book value. For Buffett, the ultimate margin of safety is intellectual. It is knowing more about the business you are buying than almost anyone else. This superior knowledge minimizes surprises and reduces risk. Over the long term, a portfolio of businesses or a series of strategic decisions made with this intellectual margin of safety will generate superior risk-adjusted returns. There will be less volatility, fewer disastrous mistakes, and a smoother, more powerful compounding of capital. It is the final governor on the engine, ensuring that the integrity, intelligence, energy, and owner's mindset of the great jockey are always directed toward the highest probability, lowest risk path to victory. You've just been given the master key to Warren Buffett's thinking, the lens through which he has viewed every major investment and partnership of his career. This is the bet on the jockey principle. It's the framework that separates a simple spreadsheet analyst from a true judge of value and a genuine partner in wealth creation. You now possess the qualitative checklist, the 5 pillars of integrity, rational intelligence, energy, and owner's mindset, and a disciplined circle of competence. This is the blueprint for identifying the human engines of success, the people who don't just run businesses, but build enduring empires of value. But here's the critical insight. Identifying the right jockey is only the first step. How does Buffett structure the deal, time he finds them? How does he create a partnership where that leader's talent is unleashed, not shackled by corporate bureaucracy? The bet on the jockey principle is one pillar in a grand cathedral of thought. It's connected to his philosophy on capital allocation, on corporate culture, and on the very structure of Berkshire Hathaway itself, a structure designed to be the perfect home for these world-class jockeys. The video that is appearing on your screen right now is the next part of that blueprint. It is the bridge between identifying talent and building the perfect system around that talent. It explains the thou that follows the dia, who. It's the link that connects finding the right person with creating the right environment for them to compound wealth for decades. An environment of extreme autonomy and rational incentive that is the secret to Berkshire's success. Most people will stop here, satisfied with this one powerful idea. But for those of you on a genuine journey toward financial freedom and executive mastery, the path continues. This isn't just about learning another Buffettism. This is about completing the mental model. The choice to click is a choice to continue your ascent from a mere investor to a true capital allocator. Complete your arsenal.